Welcome to the webinar. You have entered as an attendee in listen-only mode. Only mode.
All right. So first of all, a very good morning to all of you. Thank you once again for joining us. So hope I am audible. Right. So today's session is, as you all know, is another session, part of our deep dives with IIQF experts webinar series. Today's topic of discussion is deep learning applications and innovations in quantitative finance. And to speak on this topic, we are glad to have with us Sanjay Bhatia. Sanjay is, as you all know, I mean, just to briefly introduce to Sanjay, he has been a part of the machine learning and risk management universe for quite some time. To formally introduce Sanjay, Sanjay has done his MBA Finance and MSc in Machine Learning and Artificial Intelligence from Liverpool John Moores University, and he also has a postgraduate diploma in Machine Learning and AI from IIIT Bangalore. Currently, Sanjay is working as director with UBS Risk Modeling and Analytics team, and is in model risk management and control in the Chief Risk Office function. Sanjay is a risk management and analytics professional with more than 15 years of mainstay experience in risk models and methodology space encompassing BESL, Advanced AIRB, IFRS 9, IMM, and SSECR, Exposure, XVA, FRTB, OTC derivative pricing, and other advanced modeling topics. So previously, Sanjay has worked with various other foreign banks like Barclays, RBS, Citi, Credit Suisse, to name a few, in mostly the risk consulting space. He is also very passionate about imparting practical model understanding and insights, and has been a professional trainer for corporate and investment banks. His areas of interest are credit and counterparty credit risk, market risk, stress testing, stochastic modeling, quantitative finance, and machine learning. And we are very fortunate to have Sanjay as a part of our faculty team as well, I mean, where he teaches for our various courses in financial engineering, quantitative finance, and particularly for the machine learning for finance course, Sanjay is the lead faculty. So with that, I will hand over the session to Sanjay. But before that, just a very brief outlay. So today's session would be of like about 1 hour. And post that we would have the Q&A session. In between, maybe I'll take permission to briefly mention about the work that IIQ have been doing for like 2-3 minutes, right? And unfortunately, since the audience is quite large, so we would not be able to allow you all to speak up. However, we want the session to be very interactive. So please feel free to type in your questions, queries in the chat window. If you want, you can actually maybe mention about your background as well, and like anything specific you want to hear in realm of today's discussion, please feel free to type in. Also, if you have any questions, queries, while going through the talk, or maybe at the end of the talk, please feel free to post it. We'll be happy to take it up all during the Q&A. Right. So with that, I will pass on the session to Sanjay. I'll make you the presenter, Sanjay. Please feel free to start whenever you are ready.
Sure, Nitish. I hope my screen is visible to everyone.
Yes, absolutely.
Yep. So thanks for all of those who have joined the session, and much like every time, and you have shown participation in good numbers. And I hope this session will maybe broaden your perspective on machine learning, and specifically the topic for today, that is deep learning applications and use cases and innovation in quantitative finance. So we will talk through that topic, but the broader structure would be like this. We would be first of all talking about what is the idea behind deep learning, right? what are different kind of architectures or different kind of structures within deep learning or different kind of algorithms within deep learning. And then we will specifically talk about those application use cases which are maybe a focus area of research, a focus area of innovation in BFSI space, and a focus area for many product companies, consulting firms, the IT companies, fund managers, uh, trading firms, broker dealer firms, and all of that, right? So first of all, maybe the basic idea of machine learning is, or maybe rather the deep learning is that it is uh, part of machine learning, and machine learning is nothing but a data-driven way of building a model or algorithm, right? So instead of relying on a statistical model or a numerical model, which basically makes some assumptions, or build the model around some theory, core theory, like your portfolio management theory, or maybe uh, some some theory it is based on. Instead of doing that, the machine learning algorithm is a data driven way of doing modeling, by which we mean that it creates a kind of algorithm or a model which doesn't assume any kind of underlying distribution for the data. So there's no theoretical or hypothetical data distribution which the model assumes. Based on whatever data is thrown to the machine will understand, learn the pattern, and by learning the pattern it will calibrate itself to take different forms of data distributions. So the machine learning way of doing modeling is not about hypothesizing that the underlying data distribution is normal or Gaussian. Definitely not. It could be from one of the non-normal or non-Gaussian family, and it could change, dynamically change as the data would change. So it is not a stationary property or a homogeneous property. It is rather heterogeneous. With data distribution changes, the machine will recalibrate itself. So the machine learning, that's why we call it that the machine is programmed with the intelligence to reparameterize itself, to recalibrate itself, to re maybe adjust itself to the changing reality in the market. So if the market microstructure changes, if there's a changes in some market dynamics, market microstructure changes, some alternative asset class comes up, which become join the mainstream asset classes like your green bonds or cryptocurrencies, the machine learning models will take notice of that particular thing and recalibrate themselves automatically. So it sits somewhere within artificial intelligence, and artificial intelligence is a broader area, right? Which is also about how to create not only intelligence in machines, but how to make them locomotive and uh, do manual task, do some kind of mechanical task like which human can do, like a robot performing a surgery, maybe even some kind of a drone with some kind of ML algorithm, right? Doing some surveillance, right? So artificial intelligence is that broader area where the mechanics of the machine also comes into the picture, and it works hand in hand with the intelligence of the machine, the core software which is embedded, or the model which is embedded in the machine through machine learning. The machine learning is uh, specifically the intelligence which we embed into the machine, right? So within machine learning we have an area called deep learning, right? And that deep learning is our topic for today, and that deep learning is all about this, right? That we have somewhere a human kind of neuro science, or neuroscience, uh, how our brain functions, how neuron functions in our body, how our neurological system functions, that is being emulated or replicated in a machine. That's exactly that, right? So once there's a way to replicate the basic intelligence in a human creature, or the highest, we are the highest, or in the evolutionary cycle, Darwin evolutionary cycle, we are on the top of the human intelligence. And the basic idea behind that intelligence is the our neurological system. If that neurological system can be adopted and artificially mimicked or replicated into a machine, the machine could also someday do the same kind of task which a human is expected to do, even to the extent that it could think critically. It could be a critical thinker, it could be a creative thinker, it could be a lateral thinker, it could do all those possibilities, it could do judgmental task, right? It could do all those possibilities which how a human perform those very tasks in day to day life. So that is the basic idea, and the word deep comes from the intelligence which is deeply embedded in human, and that is referring to the neurological intelligence which is embedded in us. Right? So we have different kind of deep learning algorithm, right? Some of them are unsupervised, some of them are supervised, some of them are semi supervised, which is the middle ground. The unsupervised algorithm are like this, right? When you throw data to them, you don't have any uh, historical account of how, what is the output value, what is the dependent variable value in that particular data set, right? You throw that data to the machine, that is called unsupervised data, and those algorithms which are quite equipped to do the prediction or forecasting or classification for on unsupervised data are called unsupervised algorithm. Now unsupervised data, we also call it unlabeled data, because we don't have the empirical or observed or historical or realized value of what has happened. One example could be green bonds, right? They have recently started trading, and the liquidity is not that much in green bond trading, so it's not a deep market. So if we throw green bond kind of a data, and if we try to predict the price of green bond, or for that matter any alternative asset class like cryptocurrency, right? We don't have enough data, historical account of how the prices have spanned in the history, so that would be unsupervised learning. Still we want to do some prediction task, right? So there are certain algorithm like your uh, 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 generative adversarial network, or radial basis function, or deep belief network, or deep belief machine, or autoencoders. These kind of algorithms which are uh, although neural network based, the same idea of mimicking the neurological system of humans into a artificial neural network. They are neural network based, but they are specifically designed to address those that data set or those problems where we don't have a historical labeled account of what has actually happened for the on with respect to the variable of interest. Now the supervised is now quite obvious, that supervised, we have labeled data set and we know what has actually happened. uh, take for an example any S&P 500 index, and you want to predict the price of Dow Jones or DAC or S&P or maybe CAC or any FTSE or any equity price index, well known equity price index. And obviously you have the label data set, and you know historically, not only historically, but far away in back in history, how the prices have spanned, and what were the realized or observed or empirical values of those price series or time series, financial time series. So you will present it to a supervised learning algorithm, which is deep neural network, convolutional neural network, recurrent neural network. And then recurrent neural network could be again of different types, like long short term memory or gated recurrent unit. These are just broader paradigms how deep learning is further segregated into unsupervised and supervised. But there could be possibilities that some of the data set are partly labeled and partly unlabeled. Partly we know what has happened in the previous years or in the historical period or in the observation period, but partly we don't have any observation, right? So then we would be deploying some kind of a semi-supervised algorithm, which is something called transformers, right? So these kind of algorithms will be deployed. And the idea is that how we can make our neural network so deep that it not only pick up very low level of abstraction or low level of intelligence, it also do high abstraction task. What do I mean by high abstraction task? That it also do some kind of that kind of intelligence which a human can do, like judgment, taking decision, right? Devising strategy in the market, right? Designing some policy, right? It can do all those kind of things by applying creative intelligence, critical thinking, lateral thinking, which a human can do, which our brains are trained to do. So that is how we go about it. And on the left hand side of this slide, you could see that there are big data, and that is the reason why deep learning in is gaining a lot of momentum, right? We are getting data in a lot of volumes, right? We are getting data in terabytes or even higher orders of terabytes. We are getting data in a lot of variety, right? So we are getting data from many unconventional sources or many alternative sources, like you are getting data, uh, Twitter data or social networking data as well nowadays. Yeah, so some of your sentiment data, market sentiment data, opinions, analysts express their opinions on Twitter handle or on various social platforms, right? So that kind of data. We are getting ESG data, environmental governance and social and governance data. So climate risk data we are also getting. We are getting other events data, like weather forecast data, or maybe other event data which are extraneous event which could impact the market we are trying to study, or the market which is of interest, right? We are getting a lot of other funding data. Maybe we are getting data from various IoT devices which could measure the different you know uh, give us different impulses of the market or the trader, right? The behavioral instincts of the trader, right? We are getting locational data, we are getting transactional data, we are getting a lot of web data which we are doing, taking extracting through web scraping. So a lot of this unconventional data has never been last before 10 years, before the ongoing decade, we never had this capability to handle this kind of data, right? This data is coming in volumes, this data is coming with very high velocity, in high frequency, this data is coming in very high variety and from unconventional sources. This data is very heterogeneous character, means its distributional properties are either unknown or are not homogeneous across times. They might change distribution from one time span to another time span. So that could be also be the case. And there's a lot of data uncertainty. So the distribution is not your typical Gaussian normal distribution, right? It could be some kind of a different kind of a distribution which is left skewed, right skewed, right? Having some kurtosis, right? Some kind of a deformed distribution which is not normal distribution, how we mostly used to model our uh, conduct our modeling for various problem previously, assuming that the underlying distribution is normal or log normal, doesn't hold with this kind of data. So that's the problem, and that's why we need uh, some advanced machine learning, and the answer to that is the deep learning. The deep learning algorithm are very good at handling high dimensional data, high dimensional feature space, and when there's a very huge data and there are a lot of dimensions, lot of variables in your data set, and those the data is not a structured data. The data distributional properties are not stable or not stationary across times. Then the deep learning algorithm, which is the best in class algorithm and some kind of a state of art algorithm, are best at doing this particular task, right? So this is maybe just the starting point. So you could see maybe on my next slide that when it comes to the deep learning algorithm, like many different algorithm we talked about, the recurrent neural network or the convolutional neural network, or the generative adversarial networks, or maybe some of the transfer learning or reinforcement learning. All these algorithms are top topics for research, right? And their complexity is high, and they are considered the most advanced ML algorithms, which are disrupting the financial industry. And many fintech driven revolution is the undercurrent flowing there, right, behind the fintech driven revolution is owing to this deep learning, right? So you have all these deep learning algorithms which are doing the task there. But there are few problems or a few challenges rather with learning algorithm, and those challenges are getting addressed, or we are making good progress or advancement in overcoming those challenges. The one of the challenges, the the constraint on computational power. That constraint on computational power, right, the workhorse of deep learning, because deep learning would need multiple cores, multiple nodes to process a very deep network, because the intelligence is then conducted at various layers within that particular deep network, and various neuronic cells within each layer, right? That uh, 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 input signal processing or intelligence is conducted at various level, and it depends upon how deep we would go, but it is conducted at various levels. It is conducted at various granularity, right? So we need some kind of a high performance computing solution. So some distributed computing, or maybe parallel computing would come to rescue, right? Some kind of high end CPU and GPU power would come to rescue. Some multi-core processors would come to rescue. But the point is this, that the real potential of deep learning would be fully exploited once we have the quantum computing, right? And by we mean that the industry as a whole has investing a lot into quantum computing, and the quantum computing will bring quantum computers, and the quantum computers will fruitify the idea of deep learning, right? So that will enable us to do processing, us to harness that processing power to really build those kind of algorithms or models which could do very very nuanced task, which could solve very very high dimensional problems. And that is the progress being made, and that is the road to travel, right? So on right hand side you could see that there are various different kinds of deep neural network, and some of those are feed forward neural networks, or convolutional neural network, or maybe different kind of neural network you could see, right? uh, but the basic idea is that these neural network have been already been tried on multiple problems, and we have a quite high success rate uh, when trying these neural networks on multiple several problems. Like for example, for your time series analysis, right, financial time series analysis, like stock price or stock index forecasting, bond index forecasting, or commodity price forecasting, or derivative forecasting, right? The recurrent neural network has been used, and there are multiple research papers which says that they are better than your typical statistical models like arima or gauge or serimax or all these kind of time series models. The recurrent neural network is quite better than those statistical way of doing time series analysis or time series forecasting, right? Similarly, for convolutional neural network is very good at computer vision, right? uh, Recognizing maybe image recognition or image transcription, right? So convolutional neural network is applied to various use cases in finance. Some of them are like uh, uh, recognizing maybe throwing some images to the computer and training the computer on those images, and then based on those images, the computer will start learning, right, what kind of uh, recognition it will, or what kind of meaning it will associate with those particular images, right? So convolutional neural network is also good, but it is good for mainly for image driven task, image classification, image recognition, image processing, image transcription, right? Similarly, some generative adversarial networks, they are good at generating. So you must have heard of generative AI. So they are those kind of algorithms which are behind generative AI. So if you want to generate new data, right, because in quantitative finance we have quite a lot of problem that generally we face issues with lack of data, and sometimes not uh, good quality of data. So sometimes generative neural adversarial networks are used there. So these networks are used in for multiple use cases, and some of those use cases we will cover in the subsequent slides as we go ahead, right? But just to show you a glimpse of maybe one kind of neural network which has been relatively reasonably tried out in for multiple problems in financial with financial data or quantitative data. So that this neural network is based on the RNN, recurrent neural network. And in general the neural network are very good at few three of these things. One is handling high dimensional data, solving high dimensional problems. High dimensionality means that when your features or your variables are so huge, it grows into hundreds and maybe sometimes even multiple of hundreds, then you can't typically do a typical kind of statistical model or numerical model. You have to then build some kind of a machine learning driven model, and these deep learning algorithms or neural networks are very good at handling high dimensional data, right? And the second part is that financial data is generally very noisy. It has uh, uh, very low signal to noise ratio, right? So the generally the signal or key pattern in the data is very low and the noise is very high. With such noisy data, right, like with a lot of volatile data, where you could find barely few signals and the rest everything is noise, it is not going to hold forever, right? Those kind of patterns which I'm calling noise is not going to hold forever. They are just for that span, right? They are very short lived, right? So that kind of noise which is characterized in our financial data, right? Uh, neural networks or deep learning neural networks, they are naturally very good at handling such kind of noisy data, or also maybe de-ambiguate, right, the noise in the data from the signals, right? And then based on the signals it will estimate the network weights, right? uh, Create a network, learn the network weights and or model weights, or then maybe do some kind of a prediction or forecasting, right? So generally you see that RNN, recurrent neural network, is very good at this, handling sequential data, which is time series data, which is that data which is you know uh, you know uh, recorded at different time stamps. So a data series which is time stamped, or a sequential series, right? And it is very good at handling any sequence of any length, any arbitrary length. But when it comes to statistical model, and we were building these time series models like arima, ceremax, or some kind of a gauge arch models, we always used to assume that the input sequence is of fixed length. Now when you throw that particular sequence to a recurrent neural network, right? Even uh, recurrent neural network is that dynamic that it let that particular input sequence to take on any length, any arbitrary length or any variable length. It doesn't fixate it. It doesn't assume that the input sequence is of fixed length. Input sequence could come in any length and it would still process it, right? So that's another advantage. So just to maybe sum it up, neural networks are generally good at handling high dimensional problems, high dimensional data, right? And multi-dimensional feature space, exploring multi-dimensional feature space, denoising a very noisy data, right? uh, the estimating parameters which are very huge in numbers, because you have high dimensional problems, large number of variables, you have a large number of parameters to estimate. Neural network is the solution. uh, Specifically RNN, recurrent neural network, is very good at handling sequential data or doing sequential modeling task. And when RNN does sequential modeling task, it doesn't restrict the sequence to be a fixed length. It allow the sequence to vary. Even a sequence of shorter length could come, or very longer length could come, or any arbitrary length could come. It doesn't restrict that way. So for it, in the degrees of freedom, even the sequence of the input sequence length is you know free to vary. That's the thing, right? So that's why this kind of a network, and here you could see that these dots, blue dots here, right, are nothing but the basic neuron which we have mimicked, or where the basic intelligence is built, right? Some of the initial layers, where you have neurons, some of the initial layers starting from top to bottom, are those layers which will do the basic signal processing. And as you go forward, feed forward in the network, right, some of the advanced or subsequent layers would do the high level of abstraction, or high level of signal processing, or high level of intelligence task, right? Right, like predicting something, or maybe classifying something, or forecasting something, right? So that's why this kind of a neural network is used for algorithmic trading, uh, fund investing. A lot of hedge funds and broker dealer firms, and your quantitative trading firms, or maybe some of the managed funds, and some of the alternative investment funds are deploying their strategy based on specifically on specific architectures of recurrent neural network, which is called long short term memory, right? Which is based on Markov chain, right? By the way, right? And then there are different problems like price forecasting, price of any asset class. You talk about equity index, you talk about bond or any fixed income or security, or you talk about commodity, interest rate, forex, you talk about any thing. It is well it can handle those sequential time series forecasting task, right? Just like a cakewalk, right? Volatility forecasting is another area where there's a lot of research and interest, because anyway, that particular area, you understand that generally when we talk about market volatility or the volatility problem, we talk about volatility clustering, we'll talk about volatility smile or volatility skew, we talk about volatility term structure. A lot of those things. So generally neural networks are nowadays deployed for volatility forecasting problems as well, right? The next thing is the price anomalies detection. So many trading strategies are based on price anomalies, finding the price anomalies, because if they quickly find the price anomalies or differences or asymmetry between prices, like price of the same financial instrument in two different markets, if there's an anomaly, what they will do, they will quickly go and exploit that particular anomaly before anyone else will get to notice that on the market. So that price anomaly is a good trading advantage. So how to detect price anomalies is also one of the problems which RNN could solve. Then last but not the least is the big space of portfolio optimization, how to make asset allocation decision, how to balance your weights which you have to different asset classes, or how to dynamically rebalance your portfolio, right, with changing market conditions, with changing scenario under different market microstructures or scenarios. That is also a portfolio balancing or portfolio optimization problem to produce the a very market beating risk adjusted return. So that's also a problem which is very much attunable and configurable to RNN kind of algorithm, right? Now when we are talking and applauding that what RNN could do or what neural network could do, right, we should also talk about some of the key challenges of neural networks, because neural networks are generally good at addressing the high dimensional problem or targeting the high dimensional problems. uh, the parameters or the weights, model weights or the network weights grow so large, so huge, right, that sometimes uh, these set of parameters along with some set of hyperparameters which are design parameters of how neural network has been designed. Like one of the hyperparameter could be the depth of the neural network, how many layers you have included in the neural network, how many neurons you have within each of these very layers. So some of these hyperparameters along with the any which way the parameters which the neural network has to estimate will grow into such a big bunch, right, that it sometimes take a lot of time, and sometimes the performance is suboptimal, right, and it will sometimes lead to overfitting problem, model overfitting problem. Model overfitting problem is that it in to be able to, it is a greedy algorithm. Generally the deep learning class of algorithm, we generally term them as greedy algorithm. It will try to learn as much as they can from the data, right, it will try to learn as much as they can from the data. Sometimes in the greediness to learn, right, all the patterns from the data and try to estimate the parameters or predict something, in the quest of doing that they sometimes tend to overfit the data. Overfitting the data means that there's a data clinginess, right? The neural network which is built out of or more developed out of a particular data set could perform very good, it will give awesome results on that particular data set. But when you change the data set slightly, or when you apply that particular the same neural network algorithm to some new data set or some changed data set, the model performance or the model accuracy will start tipping off from the stupendous performance which it has shown on the data set from which it has been estimated. So that's the problem of overfitting, right? It is good at handling noisy data, but still sensitive to the noisiness in data, right? It is generally a bit of, there's a bit of skepticism, right, and doubtfulness in adopting neural networks for some of the regulatory capital models or regulatory modeling problems, or right, because generally the regulator have this particular strong argument, or staunchly they say so that they, for them, it is a black box, right? So you could literally uh, you know call a time series model or a general regression model an analytically traceable model, but a neural network is not analytically traceable because we don't know very clearly how it has estimated those parameters in the first place. What is the sensitivity of those estimated parameters to a lot of other topics, like maybe the noisiness in data, or maybe the high dimensionality of the data, right? Or the model hyperparameters. What is the sensitivity of the estimated parameters to a lot of these different issue which could change the those particular parameter estimation, right? So these are general pitfalls of neural networks. But generally, as we are in most of the industry participants are in experimental phase, exploratory phase. They are trying to disambiguate this area and trying to make it clear through multiple trials. Similar thing what happened with Monte Carlo simulation once upon a time, that people used to call it black box, right? But now it is well widely used. The same kind of experimental and exploratory things are happening with neural networks. Right? But that doesn't discount the kind of promising benefit it accrues to the way we want to go. If we want to move forward in different topics like ESG modeling or climate risk modeling, or uh, even alternative asset class modeling, we got to employ neural networks because we have no other way, because we are getting a lot of alternative data set which are unconventional. Those are high dimensional problems. The data is very noisy. The distributional properties are very uh, s- unstationary or dynamic. Distribution changes quite a lot, right? So for due to all these varied reasons, neural network still holds that kind of promises to solve all these new age problems, or uh, what we call Gen Z problems, right? Where we have to take advantage of as much data we have in our mind. We have to mine the data, not only the conventional numerical data but unconventional form of data, like social networking sites data, and maybe geo satellite data. Low orbiting geo satellites are sending us data, that kind of data, right? Even your maybe IoT data, all these kind of new age data we need to exploit. And that's why the advantages are far outweigh the kind of challenges which we have listed out here, right? So recurrent neural network again have a few kind of its own typical challenges, right? It is even more uh, embedded with intelligence. It is used for sequential task or sequential modeling, like time series problems. And you could assume, you could clearly make it out that there would be the number of neurons which a plain vanilla artificial neural network would have. The recurrent neural network and its architecture would have multiple other neurons, right? Multiple other neuronic cells which would be doing some kind of pre-processing, because now we are doing a lot of sequential task, a time series problem, right? So there are a lot of even more parameters to for the model to estimate, and the problem even grows into even more high dimensional, right? So the power and the computational power, the requirement for the computational power and time, right, is a consideration there, because that costs money, right? The other part is that maybe the if the neural network the structure, the design aspect of the RNN is not chosen properly, right? Then it would give the it would then maybe yield into underperformance. So there's a lot of fine tuning somebody has to do while deciding the design and structure of a recurrent neural network. So that's the added challenge there, right? But let's see now, the clearly see the uh, some of the use cases, right? So before we go to use cases, this is just evolution, right? That previously, you know, when it comes to our investment and trading applications within the quant finance problems, we used to follow some kind of a problems which are simplistic in nature, like momentum based strategy, trading strategy, or trend following trading strategy, or maybe some some of these basic trading strategy, mean reversion strategy, right? uh, uh, Even statistical arbitrage strategy, moving average crossover strategy, or breakout strategy. So these are the strategy we used to follow. The traditional hedge funds, the traditional alternative investment funds, the traditional funds, boutique investment banks or broker dealer firms, right? They used to follow these particular strategy, but now that has been quite disrupted, quite disrupted with uh, some kind of these four things, which is quantitative driven trading, algorithmic trading, right? High frequency trading and automated trading. So there a lot of the entire thing is built on the AI. And when we talk about AI, we have now understood that within AI, machine learning, and within machine learning, the specific topical subject of deep learning has been employed here to create these trading application or automated autonomous trading systems or algorithms which could trade, and what a front office trader could do, they could do it as well. We are building that kind of intelligence in these algorithms through deep learning, that they could do that as well. And the day is not far, and it's already started, that in many trading location like Frankfurt, or maybe London, or maybe New York, right? Traders, front office traders are being replaced by these algorithms, right? And that's we are seeing on our watch. But you could see that maybe these are different journey strategies broadly followed by these funds or trading firms, right? And trend means simply this, that the mean average, how, in which direction the market is moving. If the market long run mean is ebbing up or going up, we will try to buy that kind of asset class or that kind of security. If it is going down, we will try to, right, take a short position in that kind of security. Mean reversal strategy, the market follow, or many asset class follow mean reversal. So it means that no matter how up they are, how down they are, in long run they are going to revert to their mean average, long run averages. So here, we follow somewhere a different contrarian strategy than the trend following strategy. Here, if an asset class is uptrending, we would rather sell it, because we think that it will very soon or at some point in time revert back to its long run mean, and it is currently trailing above its long run mean, so we will sell it. We will take a short position. And vice versa, if a asset class is has a downward trend, or long run average is downward, the downward trend, currently downward trend, and as compared to its long run average, so we will buy more of it. We will open a long position in that kind of asset class. Then there's the momentum trading, right? We will based on the momentum in the current prices, and some patterns which could clearly show us a momentum building up, right? We would be purchasing and selling different positions or asset classes, right? Statistical arbitrage is basically this that the difference between two markets, the difference between two correlated, uh, there's a very high degree of correlation between two asset classes, but the price series of, or return series of two asset classes, but they are somewhere not in sync with prices. So based on some kind of anomalies, price anomalies, right? Some kind of correlational anomalies, right? Some of the arbitrage funds, or event driven arbitrage funds, or some of the arbitrage funds exploit that by moving the money from one market to another market. So these are generally global funds, and they move the money quite rapidly from one market to another market, from one asset class to another asset class, from one uh, maybe security type to another security type, and they make money, they make quick money, and they move a lot of money. And they conduct in their strategy so fast using these algorithms, right, that they are able to take the advantage of that moving average crossover strategy. So there's a threshold defined, and generally if there would be a breach of that particular threshold, you will either take two decisions: either you will take a new position or you will revise your existing position. So based on some support or some resistance measures, right, you will conduct your strategy, and you would have a threshold in mind, and the crossover point will decide what would be your position in the asset, right? So similarly, the breakout strategy has a very clear threshold which is calibrated, and generally the that particular threshold is calibrated so as to see a new evolution of the asset class. Like if there would be a breakout beyond that particular threshold, then the asset class would behave very differently. And that's why that kind of a pattern is detected, and the traders then try to take a lot of position, either long or short, in that kind of a stock, following that there's a breakout probability that there's a breakout will happen. So these kind of strategies are followed, but generally algorithmic trading, let's see what does that mean, and how the market around it is built. So generally as we talk through is deep learning, neural networks and different kind of neural networks, specifically the recurrent neural network, and within that the long short term memory architecture and the gated recurrent unit architecture, the bidirectional recurrent neural network. All these neural networks are used for maybe algorithmic trading. So it is a basically it is a process of conducting automated trading, right, executing your orders, trading orders in an automated fashion, so that the machine could automatically take a position, right, and execute an order, right. And it then take a lot of time, price, volume data into account, volatility data into account, and with some speed and accuracy, it then try to beat the market returns, risk adjusted terms, right. So algorithmic trading market is, as of now, around trailing around 12 billion, and which is somewhere expected to grow threefold to 32 billion mark by 2028. And these are somewhat old figures, right. By this time as we speak, they have already grown, I think, around touching 18 19 billion. So I think it would grow more than that, right. So that would show a CAGR, or a compounded annual growth rate, of around 11%. And some of the main players in this strategy are arbitrage funds. As we talked through, they play arbitrage, statistical arbitrage, or economic arbitrage strategies. The quant firms, which follow the quantitative trading strategies, the hedge funds, which follow different kind of event driven strategies, right. Some of the family offices and global hedge family offices, which are catering to specific wealthiest individuals and acting as hedge funds. So those kind of firms, proprietary trading firms, high frequency traders, high street broker and dealer firms, and big boutique investment banks. So some of these firms are participating in this new revolution, and they are harnessing the potential of a lot of data, like maybe most of them are alternative data sources, like satellite data, visual and images from satellite. Like if they were to forecast the uh, sales or revenue of a company, right, and that's something like Tesco or Walmart, they will take these satellite orbiting satellite images to check how many cars on a particular weekend day are parked within that particular store, or different across different stores in US, Walmart stores in US, to forecast their sales, right? They will do some aerial and drone data as well. They obviously employ a lot of social media data, IoT data, you know the green data, right, the ESG data, the climate risk data, or the carbon footprint data, and geolocation data. So these are different alternative data which they are employing, and what they are trying to do is they are doing sentiment based indicators to they are embedding some sentiment based indicators also into their strategy, to see what is the pulse of the market at the time when they are trying to deploy or devise this particular strategy. But generally, right, what is the benefit of this to the market, and what is the broader business use case? Why should market adopt deep learning algorithms, or in general the algorithmic trading, right, or the data driven way of trading, or theory free way of doing trading or investing? Why What is the broader use case all around, right? Now we understand that algorithmic or high frequency trading applications could execute the trade in fraction of seconds. We also understand that they could clearly, very fast and furious about conducting the auctions in the market, and they have a quite high market response time as well. These algorithms can calibrate themselves or their strategy based on the market data. If the market data changes, the algorithm will is not stationary. It will recalibrate itself, reparameterize itself, because all this is a data driven way of doing modeling. It is learning from the data. As new data emerges, or some data characteristics will become stale, and some heterogeneous changing dynamic characteristics will evolve, the algorithm will take it into account. So it is an autonomous algorithm which will reparameterize and recalibrate its strategy, right, based on the kind of market scenario it is trying to play with. Yeah. So then it even tries to take a minuscule advantage of even minuscule changes which a human trader could not do. Like, if I would ask you, you being in the front office and on the trading desk, you could maximum exploit ticker by ticker, right? You know some you If you are very fast and furious trader, you could exploit maybe minute by minute, or maybe even ticker by ticker. But algorithmic trading, is that fast that it could even, in a nanosecond or millisecond, if there would be some signal or some price signal, some new volume signal, some new momentum signal, some new trend signal, it would exploit then and there, right? So it has the ability to handle large volume of data, by which we mean the big data capability as well, right? Which could not be expected out of a human, right? No matter how many terminals are at your helm, or how many Bloomberg or Thomson Reuters terminals are at your helm, you can only process and consume some part of that information, but cannot entirely consume the entire information which is thrown at you, which a computer, and specifically a deep neural network, could is very much adept to, right? So what this mean for the market? The market will get a new price discovery mechanism, which is very much required in today's market. The market is coming up with new structured products, new structured deals, new kind of securitization, new derivatives, form of derivatives, right? New asset classes, alternative asset classes like green bonds, or carbon trading, or maybe cryptocurrency. A lot of these things are happening. So who will discover the price? Who will do that kind of maybe price discovery mechanism, right? So this front trading for performing price discovery mechanism can be easily conducted by the ML driven algorithm, right? uh, it enhances, because it if although there's a war, it is touted to be a war of algorithms in the market, right? So one firm algorithm is competing against another firm algorithm, and they are competing against each other, right? So it is touted to be war of AI driven trading algorithms in the market. But eventually what it would lead to, it will generate high volumes, it will generate greater liquidity, and the even those good stocks or good bonds which were not very much traded previously, or which was sparsely traded, now would be picked up and traded, right? So it would generate volumes, it would generate market liquidity, it would generate market depth, right? It will give market depth and breadth, right? And it would also to a great extent handle the problem of irrational exuberance in the market or irrational behavior in the market, which get reflected in the market sentiments. Like somebody, there's a herd mentality. If some analysts come on the briefing and say or express their opinion that it's bulls, the people start making a beeline, or in a rat race they start taking long position. If somebody says beer, you know depending upon the following of those that particular analyst, the people start taking a beer position, right? So that's an irrational exuberance or irrational behavior, or irrational some kind of a rat behavior, rat race behavior, right? Which could be completely done away when you have algorithm trading rather than human trading, because those emotional or sentiments would be put aside, and the algorithm would only be drawing cues and patterns from the data rather than some opinionated view on the market, right? So and obviously it will make a crossover, it will make our market connect even more, integrate even more, globalize even more, because the algorithms have this ability to move money from one market to another asset class, one asset class to another, move money from traditional asset classes to alternative asset classes, so on and so forth. And so it will connect the interlinkages between different markets, and it would literally make us uh, a global financial sector and a globalized economy, where the financial economy and the financial sector are quite well linked with each other, right? And this kind of market making activities and proprietary trading activities will be given a wing, right? Because these kind of activities have suffered quite a lot after 2008 2010 Lehman Brothers crisis or great financial crisis, right? But now it could be revived, so that is the hope. Because and if and that be the hope, the most of the investment banks would then invest a lot of money in deep learning and in such kind of algorithmic trading or high frequency trading or any deep learning applications, if they want to stay in the market. And the most uh, 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 you know uh, lucrative business for them is the market making business or proprietary trading business, where they could make massive profits with least investments. And that kind of business can be revived uh, you know using the deep learning neural networks. And uh, you could mainly see what kind of things we are talking about under prop trading or agency trading, right? So we have different kind of activities within or different kind of strategies within prop trading or agency trading. So prop trading has this volatility based arbitrage, statistical arbitrage, index based arbitrage, automative scalping, all these kind of different trading arbitrage based trading strategy. And basically it's nothing but exploiting the pricing anomalies between two things which are generally considered to be holding a statistical correlation between each other. Then frequency driven trading, high frequency driven, ultra high frequency driven, and some of the market making activities, right? Like order flow or on the sell side, or maybe some kind of a tick or quote information analysis on the buy side. So that kind of activity could be attributed to the high frequency trading, right? Low latency trading also maybe goes to the actual demand and supply, right? These are low latency model, actual bid offer spread, right? Bid ask spread, basically how that bid ask spread impact your price. Demand supply factors impact your price, how large orders impact your price, right? How maybe the exchanges which are co-located are, they are conducting the trading, right? Talk to trade ratio, all these things are low latency. So some of these things you could see that these are different activities which could be application areas of deep learning. So similarly on the uh, uh, agency trading side, you would have volume weighted average price based trading, total weighted average price based trading, market making activities, directional calls, dark pool execution, order slicing, smart order routing, and some of the novel algos, right, which are basket execution and so on and so forth. So these kind of things would maybe be very much in vogue. uh, uh, and the new thing, another thing which is, as I told you, that now most of the trading strategies and trading approaches also build some sentiment based indicators, right? So some of the high frequency trading firms, they are building in some sentiment based signals, right? Whether the market is driven by purely irrational sentiments or some kind of a sentiment, beer or bulls or beer, or some kind of a neutral sentiment is over capturing the market. So that kind of market sentiment indicators could also be built, but that would require the neural network to harness the power of social network and Twitter data or sentiment data, wherever these sentiments are expressed. So some kind of a natural language processing ability would also be required, which would then allow the opinions and the sentiments and viewpoints and perspective being expressed across the social media being understood well. The meaning could be associated, whether a statement means bulls, indicate bulls, bears, or neutral stance, right? And that kind of then will feed into your neural network, right? That at that point in time, what is the uh, dominant sentiment, right? Based on what we are gathering from different social networking sites where the analyst or market pundits are expressing their opinions, right? And some of the even the fund managers are also expressing their opinion. So accumulating all that and then taking a call whether the market is net to net bullish, bearish, or neutral, and then uh, you know uh, putting that signal back into the neural network, which would then use it as a sentiment indicator, right? So that's maybe the idea here. And I have built, maybe given an idea on the some of the use cases as well, which is for your advantage to see how various indicators like trend based, momentum based, volume based, or volatility based indicators, what all possible indicators could be built into some of these strategies or algorithms to make them quite extensive, right? Quite extensive. So based on what you want to, whether your strategy is purely momentum driven or trend driven or volume driven or volatility driven, or it is based on a multifaceted strategy, you could pick and choose from this list and build those indicators into your trading application, right? And then present it to the neural network to do the forecasting or prediction task, right? So that's there. And the other area which is of interest is portfolio management, and I'll just take few minutes and then we will go to some question and answer round, right? So within deep learning, right, if I go back to where I started, you could see that there's a area of deep learning, right? Another area of deep learning called reinforcement learning. So this reinforcement learning is also a kind of a related area, but it is somewhat different. The deep learning is an offline learning, which means that you are presenting data, some kind of a data to your uh, neural network, and the neural network is doing what? Neural network is trying to learn patterns, learn relationship, and then formulate those relationship in the form of some functional form, and that functional form and respective parameters then will be used to do the prediction or forecasting or classification task. That's what a deep neural network is doing. But uh, 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 in I'm saying this kind of a learning as offline learning in the strict sense that we are throwing data to the machine. The machine is still not learning online. So reinforcement learning is that area which is called online learning, where the machine not only learn from the data but also through some offline online scenarios, how the market is panning out, right? What is happening in the market currently, right? So uh, based on that kind of and generally this kind of thing is used in most of your gaming algorithms, where you play a game, because you can't train an algorithm to play a game by just learning through data, but you have to train the algorithm to play it against a real player, right? As if a human would have sat down against its opponent and playing a particular game like chess or go or any board game, right? You got to train your algorithm, and such algorithm was trained which was called AlphaGo. And you could go and check the story of AlphaGo, which was one of the success stories of deep minds, right? Which created one algorithm which had beaten one of the top champions of one of the most complicated games in the world, which is even more complicated than chess, which is called Go. So an algorithm was created called AlphaGo, which was a project of deep minds, and later on Google acquired that particular company, right? But that algorithm is still there, and that was one of the success story. The algorithm was able to beat Doll, I think one of the champions. He was one of the multi-year champions, or even throughout the decades he was the world champion, and the algorithm beaten him in straight rounds, and then the metal was proved that reinforcement learning and some of these neural networks could be used, right, to do some online learning. So online learning task could also, another example of online learning task would also be your self-driven cars, right? So you cannot train cars just by data. You have to train these autonomous driven cars or some kind of a Tesla self-driven car using an algorithm how to drive the car in a real scenario. So this kind of a algorithm is based on a reward penalty kind of a system, where you give a reward to the algorithm when it does something right, and you penalize the algorithm when it does something wrong. And overall, the objective of that particular algorithm is to maximize reward and to minimize the penalty. So gradually, as the algorithm will come across scenarios, it will make mistakes, it will be penalized automatically, and its reward points will go down, but automatically the algorithm will learn through multiple scenarios that how to uh, uh, you know conduct itself or take decisions, autonomous decisions, which would yield maximum rewards and minimum penalties. And then it would be trained automatically, it will build that kind of intelligence. This is much similar like how we have been trained to do some kind of things when we were in our childhood, and we were being taught by our teachers or by our parents, like if you do this, right, you would be given a stick. If you do that, you would be given a carrot, right? Now gradually we learned our way out, maybe how to maybe follow that kind of rule set, and how to carefully conduct ourselves a particular task under a given scenario. So now we are so intelligent that dynamically, even if the situation changes, right, we know what are the right things to do in our own mind, and what are the wrong things to do in our own context and in our own mind, how we have been trained, right? So the similar kind of reinforcement learning algorithm is used for portfolio optimization. So this is where we train the model to dynamically calibrate the weights or the allocation quota on different positions or different asset classes based on a dynamically evolving market environment. So the market environment is evolving. The policy of the algorithm is still the same, how to do the wealth maximization or value maximization, right? And the algorithm will focus on reaping the rewards and maximizing the rewards and avoiding or minimizing the penalties. So that's where this is maybe right. So this is just I'll put this picture. This is where I said that maybe uh, the basic neural network is the artificial neural network is a mimicry or a emulation of our the intelligence which is built in our brain, right? And this is how that intelligence has been lifted and shifted from a human creature to a artificial machine. Yeah. So I'll take some pause here. There's a lot of the slides which will let you know maybe what these some of like convolutional neural network, how it is so great at doing the image recognition or image processing task, right? But they are for reference for you to maybe go through and maybe understand in what context I was saying what I said, right? But I'll then maybe take a pause here and allow for the more interactive session where I could specifically answer your question, and happy to transition over to Nitish, right, to get started with that.
Sure. I mean, first of all, like, thanks for that. I mean, the talk. I mean, it was very engrossing, very informative, and I'm sure the participants also, like, again, could get a lot of insights. I mean, and I understand it's a huge topic. I mean, so we'll share the presentation of yours, and then they can actually go through the other areas as well, right? So, but in the mean, anyway, like, this is like a topic in which we can talk. I mean, there's no end to it. We can keep on talking. It's like the idea was to give a basic overview, and I think you have done a wonderful job for that, towards that, actually, right? And like, we'll go into the Q&A, but before we go to the Q&A, like, again, I would request like maybe a couple of minutes time to basically talk about, like, again, if somebody is having an interest in this field, right? So, I mean, then, I mean, we have been doing a lot of work to train and, like, again, educate people in this field. So many of you already know about us, but again, just to give a brief intro, right? I mean, I belong to Indian Institute of Quantitative Finance, and we are conducting this webinar to, not only this webinar, we regularly conduct webinars to disseminate information of various topics in the area of quantitative finance, risk management, algorithmic trading, machine learning, and artificial intelligence. And we as a body, we have been actually pioneers in the field of education and training in the field of quantitative finance and financial engineering, risk management, and quant algo trading, and AI and ML based application trading in finance, right? Without going deep into this, I mean, essentially, like, again, you can go to our website iiqf.org, and like, you can go through the work that we have been doing for almost 1.5 decades now, promoting the field of quantitative finance and financial engineering in India, right? And specifically for people who want to make a career in this field and who are, trying to go deep into this field, even if they're already working, we have curated courses, deep certificate programs, which are meant for people who are both working professionals as well as students, which they can do along with their job or along with their other degree programs. And specifically, if they want to learn all these areas, right? So, I mean, as we have seen in Sanjay's talk, this is like a very deep area. And in finance also, I mean, the applications, as with every other industry, in finance also, we are applying them quite deeply, right? And depending on one's interest on what part of the industry they want to learn, there are different certificate courses that we conduct. If somebody is specifically interested in understanding about machine learning and its application in finance, so we have a course called Certificate Program in Machine Learning in Finance. It's an 8 months course which is designed for machine learning and data science in context of applications of finance. So you have general machine learning courses. There are many institutes which teaches machine learning in general, but I mean, there are not many courses which teaches machine learning in context of finance. So if somebody wants to make a career as a machine learning expert in finance, then this is like a course which deep dives into that, understanding the machine learning concepts and then applying them into different areas of finance. I mean, be it credit analytics or risk management, algorithmic trading, derivative valuation and pricing, and all this kind of areas in finance. So it's a very specifically designed course for training people to make a career as a machine learning expert in finance. There are other courses as well. I mean, if somebody is interested in learning about the domain of quantitative finance or financial engineering, which are essentially alternatively used words to mean the same field, right? So there are a couple of courses: certificate program in quantitative finance and risk management, which is a 6 months course, a comprehensive course that deep dives into both theory and practical modeling for derivative valuation and risk management, where we teach in deep both the theoretical aspects of quant and risk, and more importantly, the actual model building in Python. I mean, we have a more deeper mathematical course called certificate program in financial engineering, which goes more deeper into the mathematical aspects. So building a mathematical background in terms of deep algebra, calculus, stochastic calculus, numerical methods, deep probability and distribution theories, and then applying that for mathematical modeling for, or other quant modeling for derivative valuation, pricing models, risk management, and all that. If somebody is interested in like applying or rather learning algorithmic trading in deep, algorithmic trading including various types of strategies, starting from financial strategies like technical analysis based strategies or price action based strategies, to going deep into machine learning based trading, to quant model based trading. So we have a course called postgraduate program in algorithmic trading, which is again for 8 months, and there we teach trading using technical analysis, machine learning, and quant models. If somebody does not want to go into machine learning or quant model based trading, we have a shorter course called certificate program in algorithmic trading, where we teach algorithmic trading in context of technical analysis and price action based strategies. These are all courses, as I mentioned, can be done part-time along with your job or along with your other degree programs that you are pursuing. These are all done through online, live, and interactive lecture sessions conducted on the weekends, Saturdays and Sundays, so which you can participate. Right. So, I mean, now I'm not going deep into this, as I mentioned. So basically, the machine, since today's topic is related to machine learning, so essentially a little bit more deep into the machine learning for finance course. But primarily, as I mentioned, this is like a course which teaches machine learning aspects in deep with all applications to different areas of finance, right? I mean, this is important because our courses are not only meant for learning. These are all career oriented programs which deeply prepares you for roles in the industry. And again, this is like, if you have done the course seriously, you would be in a position to directly join the team for which the course is intended to, depending on which course you do. But like, again, we do have a strong support on the career track. I mean, starting from even before you join our course, when we discuss with you about your overall background and the suitability of which course is suitable for your overall profile and your aspiration. So I mean, we deep dive into that, right? Starting from career counseling, then career mentorship by industry experts, where actually the experts will guide you regarding which kind of course to do, what area to target, which part of the industry to target. There's a support system on the placement. There's a dedicated placement support team. Once you successfully complete any of this course, they will work with you, do your profiling. And then support you by placing your resume to all relevant teams where they think you are the maximum chance of getting interview calls from, and then they can help you in preparation of like the interviews and all. So there's a strong support on that. Strong network of industry association, of course, being the oldest quant body in India, and like we being ourselves, working in the quant modeling industry for the couple of decades now, right? And then it's like the industry association is pretty strong. I mean, and then it is multifaceted. We ourselves are connected. All the faculties are leading leaders actually from the quant and the risk analytics or the machine learning industry. The students who have passed out in the last 14-15 years, a lot of them themselves are in like senior leading positions in the industry. So the industry connect is pretty strong. I mean, and we definitely can help leverage that and help you in finding a right job in case you have done any of our course properly and successfully. And as I mentioned, as a part of the process, resume building and all that is there. I mean, I'm not doing deep into this. There has been many participants in our courses who have done our courses. I mean, students, mostly professionals, and they have utilized these courses to further their careers in different companies, hedge funds, investment banks, international banks, commercial banks, stock exchanges, consulting firms like E&Y, Deloitte, and IT companies, and also essentially different profiles in the quant and the risk analytics industry. You all can also, if you are there already working or you want to make a career in this is something you can target. Industry association, as I mentioned, has been pretty strong. I mean, there are various capacities. I mean, it has been a long journey of like 1.5 decades. Practically all companies who have been working in the quant and the risk management domain, we have had some kind of connection with them, maybe their trainers or with people who they hire. I mean, a lot of students participate from these courses. We have conducted customized training programs, consultants and all. So this is just a small list actually. I mean, practically everybody working in the risk quant and in the machine learning industry, algorithmic trading industry, we have been having some association. Yes, and as a part of our endeavor to promote the quant field, we have worked with different educational institutes as well. To name a few, I mean, IIT Madras, IIT Roorkee, BITS Pilani, IIT Bombay, NITI, which is now IIT Mumbai, and then many others. Actually, this is again a small list. So essentially, the endeavor has always been that actually we promote this quant finance field amongst the entire population. I mean, both the professionals as well as the students, right? So anybody in getting, if they're interested in any of our course or you want to in general discuss anything, this is our contact coordinates. The website is iiqf.org. You can call us on this number and you can email to us as well, right? So let's now go to the Q&A section. There are a lot of questions that has come up. So Sanjay, I'll be collating the questions and we will discuss the questions one by one.
Yep, sure.
All right, just give me a moment. So first couple of questions is from Ajay, and he has mentioned that what is the salary expectation in a quant finance role and career trajectory? And how is, okay, and any idea how long is quantum computing away like in years? So there are two separate questions. I have asked for Ajay to also maybe share a little bit about his background so that we can actually guide him in regards to his answers. I don't see any guidance regarding that, but in general, would you briefly mention maybe a salary expectation in a quant finance role and the career trajectory?
Okay. Thanks, Ajay, for asking this question. And obviously, with these incentives clear, I think, right, your interests would get further, developed in these areas. But generally, based on for lateral careers, the lateral careers start somewhere around 6 to 7 years of experience, right? Which means that you are already in an area of risk management or some analytics, if not modeling, right? For these lateral career candidates, the market, the data scientists or machine learning role families around, they start in India, they start from somewhere touching 40. That is the lower bound, right? And the upper bound is then maybe unlimited. So there's no upper bound to that, right? You could even get more than 1 CR package if you are good enough, right? If you are quite good at some of these algorithms, right? And for starting roles, definitely, the like we also keep hiring from IITs or ISIs, or in general from market, doing various hackathons, or through various hackathons, or through various contests, right? And even the off campus as well, right? So we generally definitely offer more than 25 lakhs CTC, more than 25 lakh CTC, right? So that is the basic starting level for any of these role families, which include data scientists, machine learning expert, right? A machine learning engineer, product owner, machine learning product owner, and so on and so forth. Different roles within machine learning and data science space, right? And with respect to your question on, I think you have one question on quantum computing. So quantum computing is obviously a decade long thing, right? But that doesn't is not a obstacle in the progression of machine learning, specifically deep learning. The the uh, uh, you know i when I was referring to quantum computing is as the next promising thing, what I was referring to is that this deep learning algorithms will become the reality in every nook and corner, no matter how small financial institution or big financial institution you are, right? Once that quantum computing will be available for its commercial use in a broad sense, it will be commercial viable idea, right? As of now, obviously, big high street banks, high street broker dealer firms, high street funds, right? They could afford any which way, right, to build these algorithms, and they are investing a lot, right? But it will become then a pervasive reality, everywhere, right? Once quantum computing will, will provide its, the necessary the computing power to conduct these algorithms at the grassroots level, right? So that's and I foresee that, maybe I'm not an expert around how it is progressing, but I foresee that by 2030 for sure, right, this idea of quantum computing will start getting commercialized, right? Because we already have few quantum computers which are being deployed in our industry, BFSI industry, to perform these algorithms. But definitely those are quite few and far, right, as of now, because of the cost involved.
Yeah, absolutely. I hope that answers your question, Sajay. Next couple of questions is from Shreyas, and I would be reading out the questions one by one, because I mean these are two different questions actually. So first question is like, how feasible is it to use deep learning for on-chain analysis in blockchain technology?
So deep learning, the use of deep learning to disambiguate or to further add transparency to how the blockchains are used for designing different cryptos or mining different cryptos, or in general the mining of that sub ledger or distributed ledger technology, how to mine that is very much there. But a- as of now, it's not well proven, due to two facts: that deep learning in itself is being parallelly conducted with a new area of research which is called explainable AI, right? That explainable AI in itself has its own metrics which could throw some light on how the model is giving its prediction or giving its output. Some explainability about the output of these complex models, and adding transparency to the models is another area of research. But if that will progress, then definitely deep learning could be used. And we uh, you know personally, I have used some kind of borrowed from that explainable AI, and used some matrix like Shapley values, which is based on game theory, to explain some of the models output. But that is again an evolving area, right? So once that would be settled and we would be establishing how to explain the output of neural networks or deep learning neural networks, then that could be used for anything and everything, right? Even DNA sequencing, RNA sequencing, molecular biology, bioinformatics, right? If that could be used there, why it can't be used here, right? Obviously, yeah.
Absolutely. So Shreyas has another interesting question actually. So he has asked, how can we practically apply Nassim Taleb's risk and probability theories to reinforce model robustness, handle fat tail distributions, and embed anti-fragility principles into our financial strategies, particularly within the realm of deep learning?
I think maybe you share interest with me, right? So that's an area which I'm quite interested, and the tail modeling and the extreme tail modeling, or the black swan event, as Nassim Taleb calls it, right? So that tail modeling, as of now, is conducted under statistical modeling by using some of the distribution or event extreme event distributions, like Gumbel distribution, if you have heard of, or maybe sometimes Pareto distribution, or some other forms of distribution, gamma distribution, or these kind of distributions. But it's not really reliable, and that's where the promising part of machine learning and deep learning comes into foreplay. Now the foreplay by machine learning is that it can conduct the simulation of scenarios and the clustering of losses in the tail, that kind of behavior, that in the tail generally the losses get clustered together, right? uh, that and this it cluster with different density in different portions of the tail. That kind of analysis is already one of the research areas of deep learning. So that is one of the application area which somehow maybe I could not enumerate it, but that is another one of the key application areas of deep learning, right? And obviously if we will go from here to add some value addition to what we have already done and achieved in modeling, right? And what neural network or deep learning could bring additionally, that would be one area, extreme value theory or extreme value modeling, which neural network is quite experimentally deployed to understand.
Right. I hope that answers your question. The next question is from somebody called SK. He has not mentioned his full name. So he has asked, what are different positions and by which firms being offered in this stream? So if you have understood that question, you can take it up, or if you have not, then I can ask him to maybe add some more points to that.
I think the question is around the roles and the role families which are coming up in the BFSI, which are related to data science, machine learning, AI in general, right?
Sure.
Right. Right. So there are multiple aspects to it, but don't I would just cautiously request everyone not to discount the value of learning machine learning, because some of the role families are those like machine learning product owner, or machine learning business analyst or analytics. Those are the people who are behind, once the methodology of a particular algorithm is charted out, right? The algorithm is being created. They spend time in order to do the rest of the work in order to make that algorithm uh, productionize or deployable in a real life scenario, right? So
Right.
these product owner roles or business analyst role families are basically also evolving. They are coming up on machine learning side. It's similar to the same thing, like we have been implementing these models, statistical or numerical models, in quantitative finance, but there always used to be a business analyst or some kind of a product owner who used to do the implementation work, right? Similarly on the learning side as well, but those people would be required to hone up the skill of machine learning, understand at least if not the very intricate mathematics of machine learning, but understand the technique itself, right? Because they need to then implement those in the real life scenarios. But otherwise, the main uh, creamy or high valued role families are machine learning researcher, right, which is the highest in that value chain. Then
Right.
there's a data scientist role family who work on the data, the creation of data set for the machine learning, because machine learning, these are data hungry monsters. All the algorithms are data hungry monsters, and it requires data analysts to keep creating data sets which could be used to train that particular machine. So data scientist role family. Then machine learning data engineer, right, that is another role family. Big data analyst, that is another role family. So some of these role families are falling within the same umbrella, where the center of excellence being created to you know to design or to uh, develop and deploy such kind of AI/ML models.
Yeah, absolutely. I hope that answers your question. I mean, if you have a follow-up question on that, you can put up, and we'll taking that also briefly. Now, like again, we have already exceeded our time, so maybe for the next 8 to 10 minutes, we will quickly take off a few of the more questions. Most of it we have already taken it up. So now the next question is from Rahul, and he has asked, Sir, use of algo trading will lead to better price discovery and will make the market semi-strong efficient. So won't it make effective management ineffective? Would you like to take that question?
Yeah, so Rahul, yes, you are right. In the efficient market hypothesis, I think what you are saying, that semi-strong, is hold does hold. But what you are trying to say is, look, when the market would never be, it's always a utopian state that the market would be perfect, right? And we generally make a mistake when we assume, make it as a model assumption that the markets are perfect, right? There would be no asymmetries, no anomalies, right? There would be no entry exit barriers. The algorithms themselves, the algorithmic trading or high frequency trading, bring its own kind of market distortions or price distortions, where some of the uh, you know uh, behaviors will create new anomalies. The only thing is that the previous normal will not hold, but a new normal or abnormal will be created, which would make market inefficient, right? And with a lot of high trading, high frequency trading or algorithmic trading, moving money from here to there, from this market to that market, the fundamental analysis, the value of fundamental analysis will go down, and sometimes that in itself will create its own kind of anomalies, right? So uh, so the markets will never be fully efficient, or or maybe completely anomaly free or completely perfect, right? So that would always be the case. Yeah.
Right. I hope that answers your question. Now, like going to the next question is from, okay, so he has also not mentioned his full name. He is mentioned as PM. So the question is a little long. Let me read it for you. So first of all, he has thanked you for sharing the rich experience, and he has appreciated it. So he has mentioned, have we tried running
Hello, Ditish, I lost you completely. I don't know, is it me? I lost
And
the.
this is not audible.
Okay, okay, then yeah, I'll wait then. Alok, or maybe Vinay, if any one of you could, in the meanwhile, read the question. I don't know if you are able to.
Yeah. Yeah, I can. Let me speak the question just a second. It is from the Himanshu. The question
Mhm.
is, are there any currently available model that implies AI for order flow analysis?
Yes, order flow and order execution, all these analysis are conducted by uh, generally the recurrent neural network, right? So based on the size of the order, whether the order, what is the size of the order and its impact on uh, the so when the order is executed, right? What would be the impact of that particular size on the volume of in the market and the price in the market? So that kind of models are generally built using the neural networks, and specifically the recurrent neural network.
Okay. Mm. Yeah, next question is from Tanmay, and he is a graduate from BITS Pilani,
Mhm.
and, he's asking that BITS Pilani, and he want to learn algorithmic trading to build his own system.
Mhm.
And can you tell him that how to go about it, or how he can start?
So Tanmay, maybe might be that being a bit Spilani graduate, you are, I'm assuming you are, decently good at maths and programming, right? The other bit is understanding the domain. By domain, I means the market risk, right? Uh, Domain, and also the machine learning bit. So you need some kind of a learning or deep dive into machine learning as well as the domain itself, the trading domain or investing domain or market risk domain, right? So I think these two areas, if you could maybe find a course, if you want to at least expedite on that particular journey, or you could self learn, right, on these two aspects. So that would be a good milestone where you would like to land yourself, maybe after some time, before you will start understanding how these algorithms could be created, or what kind of coding work you would be required to do to build such kind of trading applications. Yeah.
Right. Yeah. So this is the last question we will be taking up, and the rest of them, I think, we can talk on one-to-one. And this is from Shreyas, and he's asking, could you recommend individuals akin to Nassim Taleb who you find inspiring in the specific field? Could you recommend individuals akin to Nassim uh, Taleb who?
I
Yeah,
didn't get the course. Uh, uh,
yeah.
so
He's just
is it
asking to recommend
is it
individual.
so you want me to recommend books similar to Nassim Taleb for individuals who are aspiring for these kind of careers like quant finance or machine learning or modeling or data science? Is it
I think
is that your question?
that's correct. That's correct.
Yeah, so I think we already provide a list of recommended books, good books on each of our courses, right? Which are, right at the outset of the course, we provide a list of books to individuals based on their interest, and they can pick and choose from there, and those are well categorized for different individuals. Like even somebody who want to, become an expert in risk modeling, we have a specific list of books. For those who want to go into derivative pricing or algorithmic trading, or maybe in general econometrics, have interest in econometrics, we have a list of books which we have created for people to read through those books. And yes, we do have, but that list could be provided. I think you can reach out to Nitish, and we already have that list there.
Okay, thank you, Sanjay.
Okay, then I think that's a good interaction and good participation. Thank you all for sparing your time, and with all your valuable time and effort, you have listened to me like good listeners and participated well. And I hope that such session benefit you in the future. And keep following us, and keep following our webpage, keep following us on different social networking sites, and we will plan such sessions as we go forward. And we would like you to stay hooked up to our updates, through which we will inform you the subsequent series of sessions with our practitioners, on different variety of topics which you could benefit from. And thanks again, and we would then touch base again on such session, and we'll say bye, and best of luck for your career and your choices you are making in your career, right? And I hope this is going in right direction. Yeah. Okay. Yeah. So thanks everyone. I think we can maybe then
Yeah,
close the session, wind up the session, and then
sure.